So, in short, we don't believe this rally. Obviously, we had a very tough later part of summer. There was obviously focus on tightening of financial conditions, what was coming from the key central banks. Nothing has changed in a fundamental manner. So we still think that we are going to see more problems ahead as this higher for longer rates profile beds in and starts to impinge on the real economy.
Well, this week showed us that the Fed was all dominant. We had a lot of earnings, and despite some of the revisions around forward guidance, the market still pushed very firmly stronger. This was just a reaction to the central bank, right? That we've now got this plateau. We were really done when it comes to the rate hikes, even though Powell's still dangling the potential. The market doesn't believe it. So we've now got this re-rating around the central bank activity, don't we?
Yes, and I think and I agree with that, but I also think that's maybe a bit too soon, because if you look at the Fed's Chair Powell's speech, it had a hawkish bias to it. Of course, they are focusing on the sharp increase in the long rates, so that's helping them tighten financial conditions, and that's where the market is focused on. But let's say we have another 300K plus print today, another sticky print on inflation, they will be forced to hike again. So I think, and the optionality is still there.
Will they be forced to hike again? Because inflation's been coming down. So even if we still have a strong labour market, if there's not another overshoot on inflation or another push higher, will they be forced to hike?
So the narrative they have been sending is that they are focused on the labour market. In 2021, if you remember, there was a big mistake which was made in terms of forecasting of inflation. And this time around, at least our read is that the Fed will think and look at the labour market and say, inflation can come back. And that's where you can get into trouble if you start pivoting and labour market stays strong and inflation makes a comeback. And I think that's the risk management exercise means that if not the hike, the narrative and signaling will become very, very hawkish compared to even what we are seeing right now.
I've been asking the question around, if you do hike again, you're probably going to have to hike more than once, and then that feels like a clear sentiment of even what you're saying now as well, Salman. I mean, does that mean a soft landing is actually still possible at this juncture? The data's coming down, but not quickly enough for the Fed, and I say quickly perhaps is the wrong term. They wanted to ease off, but it's not easing off the way they'd like. You still have that rampant jobs market. You saw GDP growth still maintain the high standards it has thus far. Is it still looking like that soft landing is becoming harder and harder to achieve?
So I would argue the soft landing as a concept is dead, because the reason being is that for true soft landing to happen, as inflation is coming down, irrespective of what's happening with the labor market, the Fed should be pivoting. They say, job done, inflation is coming down, we should now start cutting rates because these rates are too high, right? That's not what they're saying, as we know. They're saying, I'm going to do a table mountain like the BOE. In reality, table mountains never happen. As a signaling tool, it's a very useful tool to give. But ultimately, for soft landing to happen, they should be cutting rates as inflation comes down. That's not what they're doing. So right now, either you're arguing there's no landing and this resilience continues, and these hikes were done on some other planet, and the real economy can remain resilient, or you say that transmission channel will come back and it will affect the real economy, and consumer will start to come under pressure and so on and so forth. So soft landing somewhere which is a combination of all these good things is very much dependent on the Fed, and the Fed is not cutting.
So what data point do you first move on? I mean, is it today's non-farm payrolls number? Yes, they love PCE, but that's also remained quite resilient. Is it something else that they look at and say, well, okay, this is the data that will then move on? Do we even know? Do they know, for that matter?
As you are, I guess, thinking about it, Chair Powell says we look at a range of data. Range meanings, everything we are looking at.
Giving himself a leeway.
Exactly. It's optionality. Yes, non-farm payrolls data matters a lot. Core PCE data will matter a lot. Michigan survey data will matter a lot. So these indicators are important, and if they are indicating that there is, this economy is still resilient and inflationary pressures are still there, and the hard yard problem is coming in, then they have boxed themselves in and say, you may have to add another extra hike. And to your point, then the market is not going to think about one hike. They're going to say, they may have to go again. So that's a very sensitive and fragile situation we are in, and that's why we are questioning this market environment.